Hey guys, welcome to Wagza Forex Trading Institute. Today we'll be checking out the content of institutional order flow trading on how to identify bank's liquidity level. Ne? So let's stay tuned and check out the content. So before we get deep, we have to understand and know what is a bank's liquidity level. So checking this note is usually a zone whereby the market prices are usually to make a big reversal, and this big reversal is sponsored by the institutional market orders as they place trades or they take profits for existing trades. So when we talk about institutions, we're referring to the banks. Né? Then it's where liquidity will start playing its role because retail traders will be also setting their pending orders or stop losses on this zone. So we also have to know that the market or the forex market, it works by the law of demand and supply, which simply means that more buy orders the market will go up, then more sell orders the market will go down. Ne? So also have to understand and know how the bank's liquidity level is formed. Yeah. So we know that the banks are usually to place orders but then they split. Yeah. Is now where we have to understand the splitage of their orders. Yeah. So the reason that the banks, why are they splitting their orders, is to prevent what we call order slippage. Né? So another secret about the banks is that when they place their trades or orders in the market, they split and also place them on equivalent market prices. Né? Then this means that if, let's say, for existence or for example, they want to place 4 million buy trades in the market, they will first place 2 million orders, then they come and place another 2 million orders, then at the end of the day they place their total of what, 4 million orders. So what we call order slippage is that when they place the 4 million straight, it will take time to be activated to the market, because when they buy, us as retail traders have to be selling. So until there are 4 million buy orders to be placed in the market, it will start running only if there are 4 million sell orders that are running in the market. So this is what we call order slippage. So this order splitting, it's where now it start kicking out retail traders, because because since we know that the market works by the principle of demand and supply. Let's say, for example, we're having 3 million sell trades or positions which are already running in the market. Then the banks come and place their 2 million first, then come place another 2 million, which means the market will start doing what, going in a bullish trend, because there are 4 million buy orders that will be in the market while we had 3 million orders that are selling. Né? So this is what we call uh, institutional order flow and demand and supply theory. So we're having types of banks liquidity here. The types of banks liquidity is the double retest and also a triple retest. If we can check, we can see we had our what, our double retest 1 2, then we came and have another what, triple retest 1 2, then 3. Then these are the types of banks liquidity. Now, then going forward, we have to be able to identify a bank's liquidity. Then the first thing that we have to understand is that the first step, we look for a level where the market prices made a nice clear reversal either at our successive high or low. Then we draw a horizontal line or a square. Then we extend it further for the upcoming market prices, knowing that we can be looking to see another retest on this level, because the market, the bank traders, they place market orders on either same or equivalent market prices, because they split their orders. Then this is the important step that we have to understand. So then when prices retest and make a reversal on this zone, then we have confirmed our what? Bank's liquidity. So we'll understand more about this when we visit the trading platform. Then now we're having the categories of the bank's liquidity, which are also two. We're having official bank's liquidity and ordinary bank's liquidity. So on the official side, it's where the bank's liquidity is formed on successive highs or lows or at the key level. Then when you compare it to the ordinary bank's liquidity, is not formed on successive highs or lows or at key levels. But then the big thing or the big rule here is about what? Externally formed and internal. So checking these setups here, it's where we can see that this was formed at our successive high, a double retest, successive high. Then our externally formed liquidity is here. This liquidity pool is consisting of retail stop losses and also retail pending orders of buy stops. Yeah, then that's what we're saying is externally formed. Then we can classify it as what? Officially bank's liquidity. Then checking this other one of internally formed, it's our ordinary bank's liquidity. If you can see, it's not formed at our successive high or previous low, but then it's just like we take previous highs and lows, but then it's not created or formed at a key level, if you understand. And you can see the difference here. This was not a successive high because it was already violated by these previous highs. You can see. Then it's internally formed. You can see here, this is our ordinary bank's liquidity. The liquidity which is in here, the buy stops and sell stop losses for the selling trades are in this level. And then they're internally because we can see the market prices once retested inside these levels. So going forward, we have to be able to understand how to trade this bank's liquidity. Then we use official bank's liquidity to catch swing trades, while we use this ordinary bank's liquidity to place some scalp trades. Then on the official side, we anticipate a breakout of structure or trend after the formation of this bank liquidity, official bank liquidity, while this ordinary one we're just checking for a continuation of the market structure. Then altogether, the last point they go the same of placing trades, but then we add liquidity by doing what? By placing our stop loss either above or below the zone. Then on this ordinary side, we just it gives us an entry whereby if maybe we made a setup, we miss the entry at the start. Then okay, let's simply try to check out this on our trading platform. Then we will see and be able to identify these zones. Dear traders, as you can see, we've met again to our trading platform. Then here I want to show you on how to identify and how to trade these bank's liquidity levels. Then these bank's liquidity levels, they work on all these time frames in regardless of the time frame, as long if the bank's liquidity was formed. So okay, let me try to change this. Okay, this is a chart of Euro USD. If you can check here, it's a hourly chart. So we don't choose the time frame. Maybe say it works on only a 5 minutes time frame. No, it works on every time frame. So okay, now let's start. Okay, I'm searching. Okay, yeah, it's a clear one. Okay guys, can see here we're having a clear and nice bank's liquidity which was formed, if you can see. Okay, we take the first one here. We had a big reversal. Don't forget the steps. We had a big reversal, then we extend that successive high. This is a successive high. Then we extend. As we can see here, we had another test on the level. We confirmed that this zone is a bank's liquidity. Then we had another third one which was there to inject a liquidity. Then this type of bank's liquidity, it's a triple retest, but then the category is the official bank's liquidity. Nah. So okay, you can simply try to highlight it if you are making a setup that this is an official bank's liquidity. Yeah, waving official bank's liquidity. Yeah. So folks, as we've confirmed that this is our official bank's liquidity, then now the thing that I want to enlighten to you is that, okay, check here. Don't forget institutions or the banks, when they place trade, let's say they wanted to place 9 million buy or sell orders, they first placed 3 million, then they came placed what, another 3 million, and they came again, they placed what, another 3 million. So at the end of the day, they placed their what, 9 million sell orders. Then after the market went where, went down. So if you sold here, okay, can sell you can set your sell limit or resell stop while the market was going up. Then you add more liquidity by doing what, don't forget, we add more liquidity by doing what, by setting the stop loss to be in this level, somewhere above here. Then above this level, it consists of many liquidity, because the market, retail traders were looking to see the market breaking through and buying. Then they said that their buy stops. Then if you sold here, this was your stop loss, sell entry, then TP at least somewhere halfway before the previous low. Here TP it, or if you were scared or unable to hold till today, at least somewhere to here, if you can check. Nah. Then at the end of the day, it was a what? It was a win. Nah. So this is how we trade and identify the bank's liquidity. Then this is how they place trade. They split their trades. Nah. So okay, let's check for another bank's liquidity. This was the official bank's liquidity. Ne? Official. Okay, here we are. Or even another official bank's liquidity here. If you can check, it's clear. Big reversal, double retest, market went up. This is a retest. Don't forget the rejections and retest, they go together. Then this is the official bank's liquidity. Then we come again, we had our what, our internal one, which we call it ordinary. Okay, it was going a bearish structure. Then don't forget, ordinary, we use it to do what, to catch trades, which goes with the continuation of the trend. Ordinary bank's liquidity. Yeah, I'm trying to highlight to you if you are making a setup. Ordinary bank's liquidity. Then here it was a bearish structure. Then another what, don't forget, it was a, I can say, a big reversal. Then after, what do we do? Here we go, you can come and sell again here, and then sell here, triple retest. Official ordinary, it just goes with the continuation of the trend. Then your TP, you can set it at least here on these two levels. At the end of the day, it's a win. This one, it was a win. If you went double, then you sell here, then you TP it. If you sell here, TP it. At the end of the day, it was a win. So okay, you can see the difference between ordinary and official. Ordinary is internal. You can see the liquidity is internal, as we had previous highs. But then official is what, is external. The liquidity is external, key level. Then we didn't had a what, another maybe low or high, outside this level. Then at the end of the day, it's a win. So okay, let's simply make a setup on this bank's liquidity. Okay, let's say we're making a setup here. Let me try to shift up this chart. What's that thing? Should be having something in gray. It's not there. Okay, we'll come here. This was a bullish structure. Then we'll extend, anticipating to see a reversal. So we'll take this successive high, then we'll extend it to there. Now our prediction is for the market to do this. If it makes a double retest, then there you go. Then you sell here when market prices are moving away from the bank's liquidity. Then you place your stop loss here above the zone. You add more liquidity by placing the stop loss here. Then it's our official bank's liquidity successive high. Then our prediction is this or this. It can come and make another retest. Then at the end of the day, it go down. So this simply means that, okay, breakout of structure, official bank's liquidity, we're looking to see a break of structure. We had a bullish trend, then now we're looking to see a bearish trend. Then I'm sure you've learned a lot about identifying our bank's liquidity levels. So let's go back and finish up our structure, our presentation. So thank you folks for paying attention on this trading platform in this presentation. So welcome back. I'm sure now we have understood how to identify and trade the bank's liquidity level from our trading platform. So and then going forward with our ebook, it will be available soon. I will try to update you on Amazon. So the interesting part of this book is that all these setups are included. It includes setups, and then now it also includes what? Institutional order flow trading. And then if you need it, you can get us via WhatsApp, then we'll try to share with you. Then this our contact, but then the preferred method of communication is via WhatsApp. But then don't forget to subscribe for more upcoming videos. And the interesting part is that now I'm going to be uploading institutional order flow trading content, as this is our first video. So keep sharing the link. Then good luck, traders. We'll try to share with you more content about institutional order flow trading. We'll meet again on the second video.